Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. I hope you're doing well today. And if you're new here, every Saturday we start off the weekend right by breaking down the latest news and the hottest topics in the world of technology and cryptocurrency over a cup of delicious coffee. Now, that being said, in today's episode, I'm going to explain why we have this Bitcoin bull market and we get new all-time highs every week, plus news about Cardano and Cosmos, our usual 404 Logic Not Found segment, and more. So make sure you stick around for all the updates. Now, as we always do, let's kick it off with questions from you, the awesome folks who watch my channel and listen to my podcast. So if you want one of your questions answered, leave them in the comments section down below, tweet me at Hashoshi4, or leave them in the Hashoshi Discord, which is of course linked in the description on all platforms. If you would be so inclined, please do hit the subscribe button, hit the follow button, and click the bell so you can get a heads up whenever I post new content across all platforms. Thank you so much in advance, and let's go ahead and dive into these questions. Now, the first question of the day is from Chris Aramburu. Sorry if I mispronounced your name. First Cardano question of the day. How important is something like Cardano's Plutus playground to attracting developers, and how does it compare to others? So Cardano's Plutus playground is essentially the web-based developer environment or test environment for the Plutus smart contract language, which is based off of Haskell, which is a well-established programming language and paradigm out there in the marketplace. Now, Plutus's playground is actually fairly unique in the sense that it's been around for a long time, and they've been putting out alpha builds into this playground for the last several years now. And so people who have been interested in tinkering and testing out have been able to go and play with Plutus before it's gone to mainnet, because obviously we're still waiting for the Goguen smart contracts upgrade to the actual Cardano mainnet. Now, that being said, other networks have done the same thing with their language. I know there is a Scylla playground, for example, within Zilliqa. So this isn't necessarily a new thing or a new idea. But what is unique is that Cardano and the IOHK group that is kind of behind Cardano has done a really good job of putting out coursework already on how to develop with Plutus before Plutus is actually live and operational in mainnet, which means that there will be developers that have gotten some experience early on before everything even launches. And so I think that's really, really effective. And projects who don't have a playground, I think, are missing out on new developers coming into the space because, for example, Solidity's Remix dev environment is fantastic, and I think everyone should aspire to having something like that. It's a great integrated development environment, or IDE. So just my 2 cents there. Thank you for your question. The second question of the day is from Max Lipavor, wondering about the naming convention for crypto tokens. As far as I can tell, there are at least 3 tokens with the GRT ticker. This breeds confusion. Is there nothing to be done about it? Now, Max, this is something that a lot of people are curious about. When you go and you look on CoinGecko or the now, in my opinion, defunct CoinMarketCap, and you see, or you search for a ticker, you probably will find multiple tokens with the same exact ticker. And that is because there is no centralized authority to say, you can't take that ticker, it's already taken, like you do in the stock market. And so therefore, you do have tokens across different networks and different ecosystems that have the same ticker defined within the smart contract or defined in listings on something like Uniswap. Now, the way that you can always determine what is the legitimate cryptocurrency that you're looking for, so I'm sure you mentioned GRT, you were looking for the Graph token, and that is from the project, the Graph. You're looking for that token. You want to make sure that it's correct. You can go over to the Graph's website. You can find their, usually it's on the homepage for most projects now in the advent of Uniswap to protect people from clicking the wrong token contract when they're trying to trade on Uniswap. But you can select a page on that website and you'll be able to find their ERC20 token address. You can compare that to the one on CoinGecko or CoinMarketCap or whatever it is that you're looking. Make sure those 2 things match up and you're looking at the correct token for the project that you're looking for. So you can refer to their website. And the other thing that you can do is you can look at volume. There are a lot of tokens that don't have a whole lot of volume. And the Graph token had been blowing up over the last several weeks. You could probably easily see which one is the legitimate GRT token and which ones might be copies or just defunct cryptocurrencies that are no longer used. So hopefully that helps, Max. But the short answer is there's no way to really control this. You're just gonna have to do your due diligence and just be careful along the way. Thanks for your question. The third question of the day is from Vuder McKinney. I'm really sorry. I can't pronounce everyone's name, but please correct me in the comments. I was wondering what the outlook is on the release of Ethereum 2.0. I feel like Cardano has a good chance of catching up and quickly surpassing the current version of Ethereum and its capabilities. Could Cardano one day take over Ethereum if they're not quick enough with the updated version? Thank you for this question. Here's my thought. I believe that there are already networks out there, i.e. Elrond, i.e. In some ways, Tezos, even though Tezos has not done a really great job of pushing for DApp adoption or anything like that. But there are networks that have released proof of stake with smart contracts, with sharding and other things to make a scalable network on which you can deploy dApps. They have not yet taken a significant amount of market share from Ethereum. That's just a fact. And so Cardano has more to do than just to launch all of their features. I am a big fan of Cardano. People know this. I really like their low and slow approach. I think they're doing it in a formally verified academic way, and that's very different than a lot of other projects do things. They also did things in a totally different way. They didn't take a lot of things from other projects or other ideas. They really wrote everything from scratch in a way. So that being said, they're poised and going to be in a position to have differentiating factors when they come into the market and trying to start taking market share. But the process of doing that is not as simple as building it and then people come. There's a lot of stuff that goes into garnering adoption, and what got Ethereum where it is a pairing of being the first mover, so everyone who wanted to be involved had no choice but to use Ethereum. But secondly, since then, they've done everything possible to create an environment where developers like to build things, and then developers that build things keep users coming back. You see NFTs, you see DeFi, etc. That's keeping people in Ethereum, despite the fact that it's not so scalable and transaction fees are crazy. So what really needs to happen is Cardano and the other projects involved need to do more than just having better tech. A lot of them do right now have better tech before ETH 2.0 comes out in a couple of years. So what they need to do to capitalize on that is to market, not in a scammy way, not saying, oh, we're better than Ethereum, Ethereum is dead, Ethereum 2.0, like we're Ethereum killers. That's toxic nonsense. That does not convert people to use your product. That does not speak to what your product can do by just saying, "Oh, we're an ETH killer." That's all garbage. What you need to do is communicate to developers. What can our protocol do that this other protocol can't? What is the Cardano ecosystem going to do to bring in new users that aren't just fans of Cardano to use those dApps and get that virtuous cycle going of new dApps, new developers, then bring in new users, which brings in more developers, and it keeps going in a cycle. That's what you need to do, and you can do that with grants, with marketing. You can do that with incubators and hackathons. You can do that with providing tools and templates to build applications. There's all sorts of things that you can do to get this to happen, and I think that's what Cardano needs to do. From a pure technical perspective, comparing Cardano, which is built from scratch to solve the problems that Ethereum has, of course, it's better than Ethereum's proof-of-work network. I would be shocked and sad if it weren't. It is. But I also think that ETH 2.0 is going to be a significant challenger and still will pull a lot of weight, and projects need to do everything they can to establish themselves before ETH 2.0 is launched. And yes, I do believe it's going to be launched, but it's not a zero-sum game in this space. Some projects will win, some projects might lose, but it's not going to be one single protocol to rule them all. Many will probably coexist. So thank you for your question. Now, the next question of the day is from Mohammed Amin Bergach. Can you please explain with simple words, what does it mean, governance tokens? Why do they have value? And thank you so much. So a governance token can kind of take many forms. And a governance token in many ways, though, if you break it down to its simplest form, is a token on the network which you can either earn or buy, which allows you to participate in the actual governance of the protocol, which means voting on proposals for improvement on the network, voting for changes to the consensus mechanism, establishing grant pools and treasuries for developers and all sorts of other things. You're literally using that token as sort of a lever, as a vote or a stake or sort of a weighted vote for different protocol changes and different protocol decisions. These are in place of the traditional sort of centralized governance that you see with a lot of projects early in their development, which is that you have an open source community or a company that's developing, making decisions, choosing things for the protocol, building it, releasing it, and having everyone who runs a node sort of accept it. So it's really shifting with a token as a vote, the power of governing the protocol to the people. And a lot of projects are doing this. You see in Zilliqa, for example, if you stake ZIL, you get GZIL, which is a governance token, and there's only a finite amount of those. And so basically they're rewarding people who are involved in the network security now and helping them become, I guess, more powerful governors in the network along the way. So it's a way to facilitate decentralized governance. However, there is one thing I will caveat, and that is that there's a lot of study going on out there to evaluate whether or not many governance tokens are in fact going to be dubbed securities because they give you a say, like a share or a stock in a company in a network. However, it's really, really muddy water in this case because you're not buying anything in regards to a company. A decentralized protocol is not a company per se, it's a community. And so there's this really murky spot in terms of governance tokens. But just watch that and watch that space as you start to think about governance tokens, especially if you're going to hold governance tokens. So just laying that out there. Thanks so much for your question. And then finally, last question of the day is from Dravko Zaprianov. Wow, I think I actually pronounced that right this time. Third time's the charm. Are the huge transaction fees of the Ethereum network what's stopping the positive price action of ETH? And how are things connected, if at all? Now, honestly, I'm going to say something that might run counter to your question. I actually think in spite of the gas fees, Ethereum has blown away everyone's predictions for where it would go. Granted, the last bull run, ETH, I think, was at $1,400 or $1,500. It maybe even went higher than that. It's kind of muddy now at this point, but Bitcoin reached 20K. Now with Bitcoin crossing 50,000, close to 60, people are saying, oh, well, Ether should, if it runs in correlation with Bitcoin as it has always done, it should be higher than 2,000. So I will admit that's probably the case. And the reason why is because rather than the gas fees, I think it's because there are so many more options in the space that are done than there were in 2017. Now, when new people come into the space, they can choose kind of like, do I want to use Elrond? Do I want to test out Cosmos or Kusama or Polkadot? Do I want to, dive into Cardano? There's all these options that really weren't around back then because a lot of these projects were still trying to, complete their white papers, get those out there, start building their protocols, etc. And so I think the new money coming in is diluting what comes into Ethereum. Secondly, I think ETH 2.0 is a big thing that is causing maybe a little bit more sort of angst amongst people in terms of Ethereum. And I think being in phase 0, people are kind of waiting to see what happens with ETH 2.0 and what the timeline's going to look like. And then finally, of course, yes, you do have the gas fee problem where at peak times you have gas fees in the $100, $200 range where people that don't have a lot of ETH can't really afford to make trades or use the Ethereum network a lot of the time. So yes, I do think that it is correlated, but I don't think it's actually held the network back as much as I thought it would. And candidly, I think a lot of the price speculation is in speculation of ep.54, which will implement a base fee, burnable base fee, which will further reduce the supply of Ethereum and basically reducing inflation. It would actually become a deflationary asset by all the research. And that is something people are looking for in ETH. And I think that's what's driving the price up, despite the questions about ETH 2.0 and gas fees. So thank you so much for your question. And let's dive into the news. Now, just a friendly reminder, please be aware of scammers in the comments that are posing as me. If the comment does not have the name highlighted, it is not me, and you can report them. I'll show you that here on the screen. And also, for those who are new here every week in partnership with the folks at Cobo, they make the awesome Cobo Vault wallet. I'm giving away a Cobo Tablet Steel Seed Phrase backup in every episode from here on out. And so all you have to do to enter the random draw is to comment on the video, and I'll pick a random winner every single week. But just for transparency, the product is only available in select regions. So if you're not in a supported region and you win, I will just go ahead and send you some Bitcoin instead. So that being said, the winner of last week's random draw giveaway is here on the screen. You can see the random draw. So big congratulations to you. And of course, thank you. And I will be in touch. Of course, it would not be an episode of Crypto Over Coffee without a healthy dose of Bitcoin price analysis and Bitcoin news. So let's jump right in. Honestly, you can probably tell from my facial expression right now, that Bitcoin is crushing new all-time highs yet again. I'm sorry, that was really corny, but whatever. Having crossed the 57,000 US dollar mark, and because of how fast things move, by the end of the time that I finish filming this episode, editing it, and posting it, the price will likely be vastly different than it is now. So my apologies for that in advance. But I would also like to mention that Bitcoin's individual market cap broke 1 trillion US dollars as well, which is massive. Now, that being said, I think that people are really wondering why Bitcoin is running to new all-time highs, what seems like pretty much every single week. And there is one big answer: economics and institutions, really. Now, I've mentioned this on several episodes of Crypto Over Coffee, but institutional money is rolling in, both in the form of big business putting Bitcoin on their balance sheets in large quantities like Tesla, as well as big individual investors or funds buying up Bitcoin en masse through institutions. Now, as you know, one of the core tenets of Bitcoin is the predictable, continuously reduced rate of supply inflation by way of mining up to the total of 21 million Bitcoin in tandem with halvings. Now, in other words, at an average block time of 10 minutes, this is today, and the current block subsidy reward, which is currently set at 6.25 Bitcoin, you get 144 blocks of transactions on the Bitcoin network per day, with 6.25 Bitcoin released into supply per block. That gives the open market a maximum of 900 new circulating Bitcoin to work with every single day. Now, that is, of course, assuming that miners are not hoarding the Bitcoin that they earn, and they are, in fact, releasing it into the open market. Now, this supply constraint, more specifically, the fact that institutions and retail investors are demanding Bitcoin in large quantities and very little is being added to the supply on the market every single day, is what is pushing the price up. That is fundamental scarcity. So it is fundamental economics. People want an asset, which is demand, and that asset is scarce. There's a limited amount available and a limited amount being created every single day. That's the supply. High demand and dwindling supply tends to enforce higher valuation. So that's what's driving Bitcoin's price at a fundamental level. Of course, speculation does play a part, but this big push from last year's highs to the prices we're seeing now in 2021 is driven by demand and scarcity at levels we have not seen. Single institutions are buying up more Bitcoin per day than the 900 being earned through mining subsidies. And if holders aren't selling, there's not enough Bitcoin to feed the demand. And then again, off we go to all new all-time highs yet again because of the scarcity. So please remember, though, that when people start selling and taking profits, this also can work in the opposite direction. And that's when we see pullbacks, when demand wanes or profits are taken, which introduces more available supply to the market, thus driving prices down. Now, that's just the fundamentals, but I would love to hear in the comments below what you think of Bitcoin's move and what's causing it. Now, the sponsor of today's episode is Unistake, which is a DeFi project launching later this month, and they're aiming to make the popular decentralized exchange and swap platform Uniswap even more valuable for users and crypto projects alike. Now, Unistake's product and protocol, I guess you could say, is designed to benefit both the user, like you and me, and crypto projects as well, by providing more robust earning potential for users and attracting precious liquidity for crypto projects that are using Uniswap or listed on Uniswap. So Unistake, in essence, effectively works in tandem with Uniswap to allow users to both stake their tokens for rewards and contribute those tokens to Uniswap liquidity pools to earn a share of the trading fees for that token, rather than having to choose whether they're going to stake or lend to a liquidity pool to earn. So you have two opportunities to earn. This expands your ability to earn yield from the cryptocurrency holdings that you have. Now, this, of course, benefits the user, but it also serves a unique benefit to the various crypto projects whose tokens are being locked into Unistake and subsequently Uniswap, because it incentivizes and encourages token holders to provide liquidity on Uniswap and lock up their tokens in stake. So it really attracts liquidity for different crypto projects. Now, why does this matter? Well, on Uniswap, liquidity is the lifeblood of a crypto project. It enables the project's token to be traded and exchanged freely, and it supports the value of the token on the market. Without liquidity, tokens are effectively valueless because they cannot be exchanged easily between users. Now, the composition of Unistake is not unlike the various other DeFi projects you see on the market. It's composed of a series of smart contracts that have been audited by a third party for security, and you can view both the contracts and the audit information in more detail on their website, which I will link below. Now, I do want to give you this one caveat, and this does not just go for Unistake, it goes for everyone. An audit does not necessarily mean a project is infallible or that the smart contracts will always behave as intended. Now, things can happen, and this goes for every single smart contract on Ethereum, but I think it's worth mentioning. Now, Unistake is due to launch later this month, allowing users to earn tokens by staking and providing liquidity to pools on Uniswap at the same time. Now, if this sounds interesting to you, I would encourage you to check out their website and dig more into Unistake and what they have to offer in more detail. Again, the link will be in the description below. Now, ladies and gentlemen, it is time for 404 Logic Not Found. And for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that just need to get some attention. And speaking of attention, if you want to help this video or this podcast get some more attention from the algorithm robots, please make sure you hit like, you get subscribed, you hit the follow button, because it tells those robots that you're enjoying what you're listening to or what you're watching, and that other people might do the same. So thank you so much for that in advance. And I'm drinking coffee from Brandywine Coffee Roasters today, by the way, one of my favorite ones. Now, I keep hearing this common refrain that crypto is a casino and stocks or shares are almost guaranteed gains, as if people investing in cryptocurrency are gambling and those in the stock market are playing it safe. Now, I will say one thing before I rip this to shreds. There are people who do in fact treat crypto like a casino by FOMOing into anonymous, unaudited DeFi projects, or they go and do a huge margin trade after reading a 5-minute guide to margin trading online. Okay, so that much is fair game. That is casino-like activity. However, I take serious issue with calling someone who invests in Bitcoin using dollar cost averaging, or someone who invests in Ether and diversifies into a few altcoins using Uniswap a gambler. It's another rhetorical means by which the media and other big-mouth detractors of cryptocurrency at large can try to dismiss the value that these projects and this space as a whole has to offer fundamentally. Let me ask you this. Why are venture capitalists not called serial gamblers and written off as degenerates when they invest in a startup whose risk of failure are extremely high? The risk of those shares and dollars that those VCs put into startups they invest in getting vaporized to nothing is just as high, if not higher, than the risk of cryptocurrency companies' platform utility token price hitting zero as well. It's clear there's a double standard being applied here overall. Is there risk in crypto? Yes, there's a ton. Is there risk in stocks? Yes, also a ton. Is there risk in venture capital investments? Yes, a ton. And these are by no means synonymous investment opportunities. They're very different, but there are risks involved with each of them. So each one of them is a casino in its own way whenever you're talking about investing. You can point to the average gains in the stock market over the last century and say, okay, by trend, you're safe holding stocks long term, even though there will be really catastrophic dips along the way. But if you look at the last decade in crypto, a large majority of people who held on to Bitcoin and Ether and various other coins that are considered blue chips over that period will see a lot of growth as well, and likely a lot more growth than their stock portfolio in the same period. So we can use trends to say whatever it is that we want to say. It is high time, though, that the establishment finance crew starts to shift their rhetoric on cryptocurrency as this purely speculative adolescent joke that they've been trying to make it for the longest time. It is clear that the numbers, the hard numbers, the stats paint a different picture. Institutions and retail have been united recently in their market interest and valuation of cryptocurrencies and digital assets. And the voracious appetite, dare I say, for these asset classes should say it all. It's time to take it seriously. So if you're sitting there with the intent to die on the hill, claiming crypto is for criminal gambling idiots and stocks are the only path to riches, I present you with a firm 404 Logic Not Found. Now, some of the biggest news that I can think of in the last couple of years came out of the Cosmos camp this week. This project has done a lot, but this is the biggest news yet. And that is in the form of the largest and latest protocol update dubbed Stargate, which just launched. Now, these updates are no small network upgrade, packing a plethora of performance improvements to the network, such as fast syncing, as well as upgrades to its core Cosmos SDK, or software development kit for developers. But the most impactful launch to date for the Cosmos ecosystem is undoubtedly the Inter-Blockchain Communication Protocol, dubbed IBC for short. IBC was the marquee feature in Cosmos's white paper back in the day, promising deep interoperability between a variety of blockchain networks, in particular ones who use the Cosmos SDK to build their blockchain network. Now, the IBC is live as of this update in the core Cosmos hub, which is thought of as the Cosmos mainnet, or the nucleus of the Cosmos mainnet in their hub and spoke architecture. And this means that the floodgates are now open for the deeply integrated Cosmos ecosystem vision to now come to fruition. So IBC will allow interoperability between Cosmos and any network built with the Cosmos SDK, such as Binance Chain, Kava, and Secret Network, all networks that have a little bit of buzz right now. So this is just the beginning for Cosmos, as the vision is starting to come together now, and we're starting to have the convergence around the Cosmos ecosystem. In other news, one of the projects that has garnered quite a bit of attention after their Coinbase listing is the Graph, and we actually talked about the Graph in Q&A today. And many of you asked me questions about it when it went huge, several 100% gains and multiple run-ups for the GRT token price after its listing on Coinbase, etc. Now, first, just to get everyone on the same page, the Graph is a protocol that allows decentralized application developers to curate and create APIs, or application programming interfaces, from which blockchain data can be queried in an efficient manner. Now, when I say efficient, I mean something like speedy GraphQL queries on a web app, rather than sending 1,000 RPC requests to the Ethereum blockchain to populate a simple table of information. So that's what we're kind of working with. The GraphQL API is what you'd really be used to on a normal website. The latter is something that people have suffered through on dApps a lot of the time. So it's much faster. It's a better way to handle data and allow people to query data. Anyways, the latest and greatest big news from the project is that this powerful data protocol that once solely resided on Ethereum will now be available on a handful of other layer 1 blockchain protocols, including powerful interoperability networks like Near and Polkadot. Now, this means that the Graph is taking the same approach as Chainlink, which I think is brilliant, by the way, and that is to make their tools available to a wide variety of protocols, prioritizing interoperability protocols in order to make its tools ubiquitous across the crypto ecosystem without having to make custom integrations for each one. Now, I think this is a wise choice, and it only galvanizes the advocates behind the project, thinking that the Graph really does have potential, and I agree. Now, ladies and gentlemen, that is going to do it for Crypto Over Coffee today. I want to thank you so much for watching this and every episode of Crypto Over Coffee. And of course, I will leave a link to a video right here outlining my top 3 VPN picks for 2021 to blanket your internet traffic in a layer of beautiful encryption. And I wanted to say, I hope you and your family have a wonderful and restful weekend and week ahead. And until next time, cheers.